Okay, so the question reads: the following financial data relates to the ordinary shares of Ndoji PLC. The current market price of the shares is 15 kwacha. The dividend per share, 1 kwacha 15 ngwe. Annual expected growth rate in dividends and earnings, 10%. Average market return, 15%. Risk-free rate of return, 6%. The beta factor of Ndoji PLC shares, 1.6. So let me just explain what these terms mean. Current market price, that's just how much the shares are selling for. Okay, dividend per share, this is how much dividend you get for owning a share in Ndoji PLC. Right? Because remember, when you're a shareholder, you're entitled to dividends. Annual expected growth rate. So the dividends they expect, this is how much they expect them to grow. Okay, at a rate of 10%. Average market return. This is the average return that you can get if you invest in any company within the Lusaka Securities Exchange, the financial market for Zambia. So when you hear average market return, it's just giving you an average of what you can expect, the return you can expect if you invest in any company in the stock market, in this case, the Lusaka Securities Exchange. Risk-free rate. Okay, risk-free rate. This deals with government securities. Okay, government securities theoretically are risk-free. Okay, meaning government cannot fail to pay you. That's why we say they are risk-free. Okay, governments theoretically cannot fail to pay you. You eventually get your money one way or another. You get it. Okay. So the rule in the stock market is this: if you want more returns, you have to incur more risk. The stock market is almost like gambling. Okay, because remember, also in gambling, if you want to win more, you have to put in more money, bigger risk. Okay, if you want to win less, you put in less money, less risk. So even in the stock market, okay, if you are scared of losing your money, don't invest in companies. You can invest in government securities, bills, treasury bonds. You can invest in those. Okay. The risk of losing your money is low. But once you invest in those securities, do not expect to make a lot of money because the return is less. If you want a higher return, you have to take on higher risk. The beta factor. Beta measures risk of a share. It measures how risky a share is. Okay. The benchmark is a beta of 1. All right. So any beta that is greater than 1, it means those shares are risk. Okay. It means if you invest in that company, there's a high risk. You can make a lot of money, but there's also a risk. You can lose a lot of money. That's what beta is saying. So beta measures what is called systematic risk. Okay, systematic risk affects the whole stock market. It's not industry specific. So you cannot do away with systematic risk. Okay, it affects every company on the stock market. All right, so you are not safe. You cannot remove that risk. So the beta measures systematic risk. Okay, then the other type of risk is unsystematic risk. This risk is industry specific. Okay, so for example, like droughts. Droughts are industry specific. They're in the agricultural industry. Okay, so that's one example of unsystematic risk. Unsystematic risk is industry specific. Okay, So these are the things that you have to know before you invest in any stock market. Right. So we go to now the question. It says, calculate the cost of equity using the dividend growth model. So, colleagues, cost of equity, there are two ways of calculating it: the dividend growth model and the capital asset pricing model. Okay. So, the dividend growth model, this formula comes from the formula for evaluating shares. If you want to find the price of a share, there's a certain formula you use. And that formula is where we are getting, that's the same formula we're using for dividend growth model. Okay. So this is the formula that you need to know whenever they say the dividend growth model. Okay. KE, which just represents the cost of equity. Now, this cost of equity, okay, you can see it on two sides. On the company side is the cost of equity financing. Then from the shareholder's perspective, this is the minimum return the shareholder wants if they invest in your company. Okay, colleagues, remember that. Okay, cost of equity is from the company side, cost of equity financing. Then from the shareholder's perspective, it's the minimum return that the shareholder wants. Okay, so that they can invest in your company. Okay. So I would say what these things mean. D1 is just next year's dividend. Okay. PO, this is the market price of the shares. Okay. G is the growth rate of the dividends. Right. So usually when they bring questions involving the weighted average cost of capital, they're not going to ask you calculate cost of equity, cost of debt. This information, you have to know it. So anytime you hear anything about a growth rate and dividends, and you want to calculate the cost of equity, you're always going to use the dividend valuation model. Okay. If they just mention anything about a dividend, growth rate of a dividend, then you should know that you have to use these formulas. Okay. So this, mhm, the price of the shares, the market price of the shares. Yes, the market price of the shares. Growth rate of the dividends. So this next year's dividend, it breaks down into this formula. DO is this year's dividend or the current dividend or the present dividend. We're going to multiply this by 1 plus G, 1 plus the growth rate. Okay, colleagues? So this formula breaks down into this. Okay, DO is just this year's dividend or the current dividend. Okay, so we can get our information here. Cost of equity. All right, yes. So first we calculate next year's dividend. Okay. DO is this dividend you've been given here. Dividend per share. This is your DO, 1.5. Growth rate of dividends, 10%. Market price of the shares, 15 kwacha. So this is the information we need. This, this, and this. So let's get our calculator so that we make sure these figures are accurate. Okay, for those who are just going to be copying, let's save them so that they copy correct answers. Okay. So the growth rate is 10%, so that you convert it into a decimal 0 0.1. Okay. So 1 plus 0 0.1, that is 1.1. So you're going to multiply 1.5 times 1.1, we get 1.65. Okay. Yes. This is the dividend that is expected to be paid next year. Okay. Any questions before we move further? Mhm. Okay, for now, I would just remember it's part of the formula, madam. Okay, I'll get the concept behind the formula and let you know later on. Okay, for now, just remember it's part of the formula. Is that okay, Madam Sylvia? I'm going to do a research for you so that I find out why this information is important in this question here. Okay? Yes. Any other question? Okay, so we put this in our formula here. Okay, so this 1.65 is our D1. Okay, so 1.65, excuse me, divided by the market price 15 plus the growth rate 0 0.1, excuse me. Um, so you do 1.65 divided by 15, that is 0.11. 0.11 plus 0.1 gets 0.21. Okay, so you convert this into a percentage. 0.21 times 100%, that is 21%. Okay, so this is the cost of equity. Okay, this is the minimum return a shareholder is going to expect or want should they invest in your company. Yes. Any questions, colleagues? Very easy, right? Just remember the formula and it's like magic. Yes. Any questions? Let me check. Have I been kicked out? Let's see. Yes, Madam Chair. Any questions? It's clear. Okay. Wonderful. Let's see. Madam Betha, any questions? Madam Kathy, any questions? Okay, Madam Betha, yes? Yeah. Okay. Yes. Ask where where you're confused. Okay. I know that the formula and these terms thing. Obviously, it's these terms which are confusing you. So ask where you're not clear. Okay. Mr. Kasono? Yes, Mr. Emmanuel. Yes, I'm always recording. I'm recording. Now, I want a question from you on this topic here, because I always ask you about the recordings. What about the question here? What have you heard so far? Okay, the more questions we do, it to make sense. Okay, colleagues, do not worry. We're going to do many questions on this. All right. Just remember, when they ask you to find cost of equity using the dividend model, this is the formula. Okay. Yes. First, calculate next year's dividend. Then just put everything in the formula and you solve. What you get, which is your answer, is the cost of equity. From the business perspective, this is the cost of equity financing. Okay. From the shareholders' perspective, this is the minimum return they want should they invest in your company. Okay. Part B, calculate the cost of equity using the capital asset pricing model. Yes. So this capital asset pricing model, what it just says in simple terms, more risk, more return. Okay. More risk, more return. And another practical use of this capital asset pricing model, it is used to find out if shares are overvalued and undervalued. Remember that sentence because in fourth year, you're going to come back to this again, colleagues. This is coming back in fourth year. BBA and accounting and finance. Those who are doing marketing and other programs, after this year, you can forget what this means, okay? HR, you do list project management, something like that. And then HRIS, you can forget. HR can forget this. Although these are very important concepts to know, especially if your company is a public limited company. This information is dealing mostly with public limited company. So if your company is a private company, this information is of no use. This is for public limited companies, the ones who sell their shares on the stock exchange. Okay, so capital asset pricing model, in simple words, more risk, more return. Okay, this is the formula here. Okay, KE risk-free rate. As I said, this is the interest rate for government securities. Okay, that's the risk-free rate. B beta measures the riskiness of a share in relation to the market. Okay, maybe let's see this through a diagram. Okay, the market beta is a beta over 1. Okay, so if the market increases by 10%, and let's say if you have got a beta of 2, the share price for your company is going to increase by 20%, meaning you're going to earn more returns than the average company, the than other companies that are in the stock market. Okay, if the beta is greater than 1. But on the flip side, if the market goes down, say the market also goes down again by 10%, your company is going to go down by 20%. It's going to do worse than the market, meaning you're going to make more losses. Okay, so the higher the beta, more returns, but also more losses. Okay, it's just measuring how risky a company's shares are in relation to the stock market. Okay. Then RM is the return on the market. As I said, this is the average return that you're going to get if you invest in any company in the Lusaka Securities Exchange. Okay. Now, colleagues, I notice no one is writing down the notes. We need, okay, wonderful. Wonderful. Yes. Okay. Those who are not writing down notes, this topic will confuse you more and more. Write down notes, colleagues, okay? Write down notes. Yes, Madam Kathy, what was your question? Mhm. Risk-free rate, interest rate, interest rate that is associated with government securities, the treasury bills, treasury bonds. Yes. Riskiness of a company's shares in relation to the market, in relation to the stock market. Hmm. Or to type them down. Okay, okay. No, I'll send you the notes for this capital as a pricing model and these definitions. Okay, I'll send you the notes. Yes, but it's also just good at least as you are learning, you write it down so that when you go for your actual lectures during the residentials, you're getting down notes. Okay. Yes. Yes. RM. Yes. Return on the market or the average return on the market. This just tells you the average return you can get if you invest in any market, any company in the Osaka Securities Exchange. Okay, so if we say the average market return is 10%, it means if you go to the Osaka Securities Exchange and you invest in any company there, expect a return of 10% on average. Doesn't mean you get that 10%, but on average, expect a return of 20%. Then RF, this is again the risk-free rate. Okay. So this RM minus RF is what is also called the equity premium. Equity premium. Okay. It is just the extra return when we say equity premium. Okay. It's just the extra return you get for avoiding to invest in risk-free securities. The extra return, maybe this one I need to type it out, okay? In simple words, equity premium, okay? Because remember, as I said, in the stock market, if you want more returns, invest in shares that are risk. So someone who invests in companies versus someone who invests in government, that person who has invested in the companies is going to get more return than the person who has invested in government. That's what the equity premium is. Okay. You who has invested in the companies, you're getting an extra return compared to the one who has invested in government. And so equity premium, extra return when you avoid government securities. Okay, in layman's words. Okay, when you avoid government securities. Okay, in simple words, that's what the equity premium is. So in a question, if you see the word equity premium or market premium, just know they have already done this subtraction for you here. Do not subtract again. They have already subtracted for you. Okay. Yes. So now we just put this in the formula. Risk-free rate, 6%. Okay. All this information is here. Uh-huh. Negative. You won't have a negative. There's never a negative equity. It's always positive. Now, let me put it like this: you always get more return if you invest in riskier securities. Uh-huh. Now, that's actually a good question. I've never thought of it from that perspective. I've never thought of it from that perspective. I'll go and research for you, okay, madam? If you get, yes, if you get, although in actuality, if when you invest in these other securities, if you make a loss, you have made that loss. The one who has invested in the government securities will never make a loss, theoretically. Okay, but I'll research on that question, madam. Is there an opposite of the equity premium? Meaning, if you get a negative return compared to the risk-free rate, is that the way to phrase your question, Madam Lavette? Okay. Yes. So, colleagues, all these values are from here. Okay. No need to ask, sir, where is this figure coming from? They're all coming from here, nowhere else. Okay. Mhm. So, um, the risk-free rate 6%, equity beta 1.6, return on market 15%, risk-free rate 6%. So, order of operations, you start with the parenthesis 15 minus 6, 9%, meaning you're earning an extra 9% when you avoid government securities and you invest in these companies. Okay, that's the extra return you're getting when you avoid the government securities and invest in companies on the Osaka Securities Exchange is 9%. Okay, then you say 9% times 1.6, 14.4%. 6% plus 14.4%, 20.4%. So the cost of equity, according to the capital asset pricing model, is 20.4%. This is the minimum return that the shareholder should expect if investing. Uh, I don't know if it's Doji Limited. Yes. Or this is the cost of equity financing for Doji Limited.